Welcome to Breaking News to Trading Moves. We're looking at the headline that, well, everyone in the energy sector is talking about today. Devon Energy has agreed to acquire Coterra Energy.
It's the $58 billion question of the day, isn't it?
That's the valuation, $58 billion, and it's an all-stock merger. I mean, when you put these two together, you're looking at a U.S. shale heavyweight.
Oh, yeah.
Something like, what, 1.6 million barrels of oil equivalent per day? That is a massive amount of output from a single company.
It's a substantial figure, for sure, but I think it's important to frame this correctly right from the start. This isn't some bolt from the blue.
Yeah.
It actually fits a pattern we've been watching in the sector for the last couple of years. It's a classic consolidation play. The goal is scale. It's about combining to create a platform that's more durable, more efficient than either company could be on its own.
We've definitely seen this script before. But the scale here feels a little different. Producing 1.6 million barrels a day puts them in another weight class entirely. This isn't just another mid-sized merger. This creates a legitimate major independent producer.
Precisely. And the market's reaction reflects that. So I think what we should do is walk through the mechanics of the deal, and then as we always do, we can break down the specific winners and losers in the market.
Okay.
Because when a company this size gets formed, it really changes the gravity for everyone else.
So let's start with those deal specifics. You said it's all stock. What's the ownership breakdown look like?
Post-merger, the current Devon holders will own about 54% of the combined company.
Leaving 46% for Coterra holders. And they're keeping the Devon name. Is that right?
Yes, the Devon brand stays, and the headquarters is moving to Houston.
That move to Houston just feels inevitable, doesn't it? I know they had strong roots elsewhere, but Houston is sort of the center of the universe for this industry.
It is.
If you're going to be a giant, you operate out of Houston.
It's about being close to the talent pool, the deal flow. But, what matters more than the zip code is the strategic motivation. They've put a very specific target on the board. $1 billion in annual pre-tax savings by 2027.
$1 billion. That's a nice round number. Is that, is that just corporate speak, or is there a real path to cutting that much cost?
It's always a bit of a mix, but in this case, the path is actually pretty clear. It comes from operational overlap.
Right.
You run two separate corporate structures. You've got two HR departments, two IT systems. You merge those, you get immediate savings. But the real value, the sticky value that comes from the field.
From the drilling operations.
Exactly. And alongside that savings target, they've outlined a $5 billion shareholder returns plan. So dividends and buybacks.
And that's the key phrase we keep hearing, isn't it? Scale plus returns. It seems like the old growth at all costs era is dead and buried.
Oh, it's been dead for a while. The new religion in the shale patch is discipline. Investors don't want companies pouring every dollar of profit back into the ground just to say they grew production.
They want the cash back.
They want cash back. And to generate that cash consistently, you need scale. You need to be big enough to run a factory-style operation where you're just wringing out every last inefficiency.
Okay, so Devon and Coterra get together, they cut costs, and they hand the savings to shareholders. That's the pitch.
That's the whole pitch, and it changes how they interact with everyone else in their supply chain.
Well, let's get into that. Let's talk about who actually benefits from this besides the shareholders. We have to start with the companies themselves, right?
Yeah.
We're talking Devon Energy, ticker DVN, and Coterra Energy, ticker CTRA.
These are the obvious winners, the large cap consolidators. And the rationale for them winning, it really goes back to the map. If you look at a map of the Delaware Basin, which is, the best part of the Permian, Devon and Coterra have assets that sit right on top of each other.
And that proximity is where the magic happens. I was looking at some of the acreage maps, and it's like a checkerboard. If you own a square here, and I own the one next to it, and we're separate companies, we both have to stop drilling at the property line.
Exactly. You have to leave a buffer. You have to move your whole rig. But if we merge, that line on the map just disappears. Now, instead of drilling a 1-mile lateral well, we can drill a 2-mile or even a 3-mile lateral.
And the economics of a 3-mile lateral are just drastically better, right?
Substantially better. You only pay for the vertical part of the hole, the expensive part, once. Then you just keep drilling sideways through the rock.
Okay.
The longer you go, the cheaper each barrel becomes. That's a huge part of where that $1 billion in savings is coming from. It's not just firing middle managers, it's engineering physics.
Plus, they can share infrastructure, I'd imagine.
Right. Water handling, gas gathering systems, roads. If I built a pipeline for my water and you're next door trucking yours, that's inefficient. Combined, we just put it all in the same pipe.
There's also the inventory aspect. We talk a lot about inventory depth in this sector.
It is the most critical metric for long-term value. In shale, your wells decline fast, so you always need new places to drill. By combining, Devon and Coterra create this massive catalog of drillable locations.
Right.
This lifts the durability of their free cash flow. Investors will pay a higher multiple for a company that has 15 years of prime drilling inventory versus one that only has 6.
So DVN and CTRA could get a higher valuation because the market trusts they can keep this machine running for longer.
Correct. We call it a re-rating. The market looks at the new company and says, you're safer, you're more durable, so your stock is worth more per dollar of earnings.
Okay, so the consolidators win, but they don't operate in a vacuum. They've got to move all that product. Let's talk about the midstream sector, the pipeline operators. Who wins here?
Here we're looking at the big players like Kinder Morgan, ticker KMI, and the Williams companies, that's WMB.
Now, I have to play devil's advocate for a second. Usually when your customers merge, that's bad for you. If I'm a pipeline and I have 5 customers, I have some leverage. If they all merge into one giant, they can come to me and say, lower your fees or else. Why is this a win for KMI and WMB?
That's the intuitive take, and in, say, retail, that's often how it works. But in energy infrastructure, the dynamic is different. Pipelines are capital-intensive, long-term assets. What kills a pipeline company isn't slightly lower fees, it's counterparty risk.
You mean the risk that the driller just goes bust and stops shipping oil through your pipe?
Exactly. If you have 10 small customers, 3 of them might go bankrupt if oil drops to $40. Then your pipe is half empty and you're losing money. A company the size of this new Devon-Coterra entity is investment grade. They are not going anywhere. They're a fortress.
So it's about the quality of the paycheck.
It's about bankability. Kinder Morgan and Williams, they want to sign 10 or 15-year contracts to support new infrastructure, especially for things like LNG exports. You can't sign a 15-year deal with a small, risky driller. You can sign it with Devon.
So the volume is safer and the contract is more solid.
And the operations are smoother. This new giant is going to have a very steady, factory-like drilling program. That predictability allows the pipeline operators to run their systems more efficiently. So yes, they might negotiate a bit harder on price, but the stability and the volume guarantee are worth far more to KMI and WMB in the long run.
That makes sense. Stability is the premium product. Let's move to the people actually doing the work in the field. The oil field services. We have to split this group, don't we? It seems like there's a divide between the high-tech players and the commodity players.
There's a very sharp divide. The winners here are what we call the efficiency-focused oil field services. So you're talking about the giants like SLB, ticker SLB, and Halliburton, HAL.
And again, why do they win? Devon is trying to save $1 billion. Surely they're going to squeeze Halliburton on price.
They'll try to get the best price, certainly. But remember the goal. Efficiency. You don't get efficiency by hiring the cheapest guy with a rusted-out rig. You get it by hiring the company that can integrate with your digital systems, use real-time data to steer the drill bit, and guarantee the well is drilled in 10 days instead of 14.
So it's a flight to quality.
Yeah.
Devon needs a partner that could operate at their scale.
Exactly. When you're running a program this big, standardization is everything. You want the same well design, the same completion technique across hundreds of wells. SLB and Halliburton are really the only ones with the logistical footprint and the tech stack to deliver that kind of consistency.
So SLB and HAL get the volume because they're the only ones who can really handle the complexity.
And they can help Devon hit that billion-dollar savings target through technology, not just by cutting their prices. That makes them a strategic partner, not just another vendor.
Okay, so we have our winners. The deal makers themselves, DVN, CTRA, the pipelines, KMI, WMB, and the tech services, SLB, HAL. But this is a zero-sum game in many ways. If scale is winning, who's losing?
The primary losers are the subscale U.S. E&P operators, the smaller exploration and production companies. We're looking at names like SM Energy, that's ticker SM, and Comstock Resources, CRK.
And when we say subscale, we're talking about companies that might still be worth billions, but compared to the new Devon, they're tiny.
Everything's relative. In a market dominated by $50 billion giants, a $5 billion company has a problem, and it's the cost of capital.
Okay, explain that for us. Why does being smaller make your money more expensive?
Well, it really boils down to risk. Large institutional investors, the pension funds, the big asset managers, they want liquidity and safety. They can pour money into Devon easily. For a smaller name like SM Energy or Comstock, the risk profile is just higher.
Right.
One bad quarter, one operational miss, and the stock can get hammered. Because of that risk, investors demand a higher return.
Which means their stock price is lower relative to their earnings.
Exactly. They trade at a discount. And that puts them in a bind. They have to work twice as hard to prove they're relevant. They face pressure to grow, but they don't have the cash flow engine that the new Devon has.
It sounds like they're sort of stuck in no man's land. Too big to be a startup, too small to be a major.
And that makes them vulnerable. They might be forced into mergers themselves, but they won't be the ones calling the shots. If Comstock or SM Energy goes to the negotiating table now, they're doing it from a position of weakness.
So SM and CRK are on the watch list. The market is asking them, what's your plan to survive in the land of giants?
Precisely.
Now let's go back to the service side. We said SLB and Halliburton win. So who loses?
The losers are the spot-exposed oilfield service names. Companies like Patterson-UTI, ticker PTEN, and Liberty Energy, LBRT.
And the distinction here is that they provide the more commoditized services, the rigs and the fracking crews, without all the high-end digital integration.
They have good technology, don't get me wrong, but their business model is much more exposed to the day-to-day spot market price for their services. And this goes back to that buyer-power dynamic we touched on.
The Walmart effect.
Yes, exactly. When Devon and Coterra combine, they become a massive buyer of pressure pumping and drilling rigs. They can go to a vendor and say, look, we have work for the next 3 years, bundle it all together, give us a massive discount and guarantee performance. If you don't, we'll walk.
And if you're Liberty or Patterson, you can't really afford to lose a customer that big.
You lose your pricing power. The customer base is consolidating. There are fewer phone numbers to call to sell your services. That competition among the smaller service providers to win that one big contract, well, it leads to margin compression.
So PTEN and LBRT are getting squeezed by the very scale that the producers are celebrating.
It's a transfer of value. The efficiency gains Devon is bragging about, some of that is coming directly out of the profit margins of these service companies.
That is a tough spot to be in. Now we have one final category of losers, and this one kind of affects the broader economy. Gas-heavy industrials. Companies like CF Industries, ticker CF, and LyondellBasell, LYB.
This is the macro angle, and it's a crucial one. These companies consume massive amounts of natural gas. CF Industries uses it to make nitrogen fertilizer. LyondellBasell uses it for plastics and chemicals. For the last decade, they've had this huge advantage. U.S. natural gas has been dirt cheap.
Because the drillers were just drilling like crazy, flooding the market.
Right, it was the shale gale. Producers were prioritizing growth over profit, so they just kept drilling even when prices were low. That meant companies like CF and LYB had input costs that were rock bottom compared to their competitors in Europe or Asia.
But with deals like this one, that behavior is changing.
That is the pivot. Consolidation brings discipline. The new Devon isn't going to drill into a glut. If gas prices are low, they'll throttle back production. They can afford to wait. They're prioritizing returns over volume.
So the supply of gas becomes more managed. It's not just a fire hose anymore.
Exactly. And over the long run, that puts a floor under natural gas prices. The days of sub-$2 gas might be ending because the producers are finally acting, well, rationally.
And for a company like CS Industries, if gas goes from $2 to $4, that hits their bottom line hard.
It creates a structural headwind. Their primary raw material is getting more expensive because their suppliers are getting smarter and bigger.
So CF and LYB are watching this merger and thinking, our free lunch is over.
The era of cheap inputs is certainly under threat.
This really brings us back to the central theme of this whole story, doesn't it? Maturity. We're watching the U.S. shale industry grow up.
It is. It's moving from that Wild West phase, all about land grabs and rapid drilling, to a more industrial phase. It's about manufacturing, logistics, and capital discipline.
And just like in the auto industry or the airline industry, eventually you end up with a few massive players who control the pace of everything.
That's the destination. And while that's great for the shareholders of DVN and CTRA, it changes the landscape for everyone else, from the small driller trying to compete, to the service company trying to maintain its margins, to the industrial giant that's buying the gas.
It's a fascinating evolution to watch. We'll have to see if Devon can actually hit that $1 billion target, but the logic is certainly there.
The blueprint is set. Now they just have to execute.
We will leave it there for today. A big development in the energy landscape with plenty of trading moves to watch.
Please note that this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Thanks for listening. We'll catch you on the next one.